Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Wednesday, the 30th of October. I'm Daniel Lam, your host for the podcast. Indian versus Chinese equities. This is always a frequently discussed topic amongst investors, especially after the sharp rise in Chinese equities in the month of September and the recent weakness in Indian equities. Well, the third quarter Chinese earnings season is modestly optimistic, with overall sales growth at close to 20% and earnings growth surged by nearly 60%, although this was likely due to a low base effect. In fact, the earnings surprise is slightly below zero, reflecting disinflation headwinds and stagnant domestic consumption growth. Valuation is still compelling even after the recent moves. Consensus expectations for 2025 earnings growth also appear to be stable at 10.5%. That said, we do need to see further details on the stimulus and the impact on investor sentiment. So we continue to favor high dividend non-financials SOEs due to their income stability and stable cash flows. From a sectorial perspective, we're overweight technology, healthcare, communication services, and consumer discretionary, all of which are projected to have a higher earnings growth than the broader MSCI China Index in 2025. Meanwhile, Indian equities have been pulling back after touching an all-time high in September. Foreign investor outflows total approximately $9 billion in October, month to date, the sharpest monthly outflow since March 2020. Now, the outflows were arguably driven by reallocation to Chinese equities. There are also several other factors. First of all, high-frequency indicators point towards a gradual normalization in economic activity from their earlier strong pace. Secondly, the third quarter earnings has been lackluster so far, raising concerns of downward revisions to 2024 estimates. Finally, Indian equities continue to trade at a valuation premium relative to China and other Asian peers. So therefore, over the short term, we're expecting volatility to remain elevated in Indian equities as markets adjust to these factors. But over a 6 to 12 month period, the still robust economic growth and corporate earnings cycle continue to support our positive view on Indian equities. In addition, there has been robust domestic investor flows and also low foreign investor positioning. These are supportive factors for Indian equities. That is all from me for today. As always, if you enjoy these podcasts, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.